Hey there, I'm Justin Spencer Young. I'm the valuologist. Just recently, I spent a day in the classroom at the Gordon Institute of Business Science, where I teach on a regular basis. And this specific day was with a group of senior managers from Discovery. And my brief for the day was to explore the dynamics of value creation. We had a fascinating day in the classroom. It was just prior to the big announcement of the launching of the new Discovery Bank. So there was lots to talk about. And of course, we covered some of the real dynamics of value creation, and we explored whether Discovery is creating or destroying value. So after the day, I put together a video that highlighted some of the conversations that we had during the day, but specifically explored why the detail matters when you are looking at value creation. If you use some of the on-the-surface numbers that appear in the income statement and the balance sheet, often you get bogus results when it comes to measuring value creation. So in this next video, what I explored is the detail that you need to go into in order to fully understand and unpack whether value is being created or destroyed in the business. So I hope you enjoy my discussion on value creation at Discovery.
Welcome to Value Creation. This is a short video on why the details matter. Just last week I spent some time with the management team at Discovery, and we were exploring value creation, and we looked at the components that drive value creation and why value creation is important, and we did some calculations around the value creation at Discovery. And what became very evident was that by doing some calculations using what I call the on-the-surface numbers, we produced some results that were very misleading, and we had to make some adjustments to the numbers in order to get to the right results, the correct results. So I thought it important to outline those adjustments that we made, and those are the details that I referred to in the heading of this video. So by way of a recap, we can start off with our cheat sheet. At the bottom here, you have the DuPont decomposition making up profitability, activity, and leverage. And you would probably recognize a lot of the data that's in here. I'm interested in this piece here. It's the part about what is value. And in here we have the EVA calculation, which essentially determines the profit from the operations of the business and subtracts from that the entire capital cost, the debt cost and the equity cost that relates to the business. At the top here under leverage, you see my diagram representing the simplified version of the balance sheet, and specifically the finance-orientated version rather than the typical accounting version. And when I say the finance-orientated, I mean that because here we have the capital that's raised in order to fund the business, and on this side in operations you might call it the use of that capital. And the reason why I say this is quite simplified is because, as you'll see in a moment, when we dive into the Discovery balance sheet, you'll notice that these capital components don't simply consist of debt and equity, or two numbers. There's a whole lot of numbers in here that the accountants provide, that the accountants would argue, in the interest of transparency, provide all the liabilities that the business is subject to. But there are numbers in there that don't represent the invested capital. And by invested capital, I mean the actual money put into the business where shareholders expect a return on that money. And of course the debt components where the financial institutions expect a return. So we have to go and find the subtleties. We have to look into the detail in order to specifically calculate the value creation. So let's get into this. Here's the Discovery income statement. We have data here for Discovery from 2009 up until year end 2017. Cursory overview: turnover here 2009 5.1 billion, growing to 33.5 billion by 2017. Along the way here you'll see two substantial years of growth, 2010 2011, where the revenue is in excess of 50% growth rate. As a cursory look at the operating profit in 2009, we had nearly 31% operating profit margins. What follows is a general decline in these operating profit margins down to essentially 15% here in 2013. This grows back up to 19% in 2015. Sorry, did I say 15% in 2013? Growing back up to 19% in 2015, and then a sharp decline in 2016. At the profit after tax level, a very similar trend, 23, let's call it 24% profit after tax numbers, declining all the way down here to 12% in 2013, and then some improvement back to 2015. And here this sharp decline in 16 and 17, somewhat concerning, seeing how those profit numbers have declined. As far as value creation is concerned, EVA, we want a positive number here which represents value creation. You'll see that Discovery has created value in every year of our data set here, except for the last 2 years. These numbers start to turn negative, and you will also note how these returns on invested capital, and I'm going to show you these calculations in a moment, how these returns on invested capital are less than the cost of capital. Cost of capital in Discovery in the region of between 17 and 18%, depending on which year you look at it in, but pretty close to 18%. So that's a quick overview of the income statement. I'm actually more interested in the balance sheet, because that's where the detail comes from when we calculate our returns. So this is the capital portion of the balance sheet. In other words, where's the capital been raised? So in our rough and ready balance sheets, we said, well, we have equity and we have debt. But now you'll notice there are a whole lot of items here other than just equity and debt. And under the total equity, it's made up of ordinary share capital, money originally put in by shareholders, share premium, that's money raised in additional share capital over time. We have a non-distributable reserve. You perhaps could call this a revaluation reserve. Here's distributable returns. I prefer to call it retained earnings, and distributable reserves is the name that my database uses. And then the minority shareholders' interest. Preference shares is often a discussion about whether this is debt or equity, but in essence this is money that comes from shareholders. And then we've got some components here that don't represent money from either shareholders or debt providers, but they fall into accounting definitions and essentially produce some additional transparency in terms of these liabilities that the business have, deferred tax and other non-current liabilities. And there's a few others here in the context of Discovery and many other listed companies. They often don't have numbers associated with them. Convertible debentures, directors and shareholders loans. Here's a non-interest bearing long-term loan, and what I'm more interested in is the interest bearing long-term loan, because that has a cost and we can simply call that long-term debt. And the sum of all these items gets us a total capital number. We'll see that growing here from 11.3 billion in 2009 up to 65.5 billion in 2017. So some good growth going on here in the balance sheet. If we drop down to the operations component of the balance sheet, at first glance, it's important to notice that the net asset number here represents exactly the same as the total capital number. So let's see what makes up, or how is the capital being used in the business. Fixed assets 219 million, growing to 1.2 million. Intangible assets, this is largely a goodwill component that's come about through various acquisitions that Discovery's made. 520 million growing to 7.2 billion. Here's a number that's grown quite considerably: investments and loans, and this is 4.1 billion, and it has grown here, you see, to a number of 69 billion. That's some material growth. Here's the working capital component, the net current assets, and what's interesting here is the working capital component is a negative number, and the reason for this largely is this item here, which are trade payables, money owed to suppliers mostly, and that's a material source of funding for Discovery. And what's important about this source of funding is it doesn't fit into a traditional debt type of funding structure, in that it doesn't have an interest cost to it. So you could say, in inverted commas, that funding is free. And it's definitely important to Discovery's operations and how they fund them. But let's move on. Let's get on to the calculations of value creation, because it's in this detail that it really matters. So the first two measures you'll see at the top here are what I call the on-the-surface calculations of RONA and return on equity. RONA is taking the operating profit and dividing it by the assets in operations. Return on equity is taking the profit that belongs to the shareholders and divides it by the shareholders' numbers, or the shareholders' investments. And what's important to note here is that the RONA, based on the surface numbers, is consistently less, if you look at all the years, consistently less than the cost of capital. Now, traditionally that would mean that the company is destroying value. They're not generating returns that are sufficient to meet the capital cost. And if we did a EVA calculation, economic profit if you like, and we use NOPAT here, so in NOPAT we're adjusting the EBIT to take out the tax, and we say, well, here's the profit that comes from the operations, and let's subtract from that the capital cost. That's the piece in the brackets here. It would tell us that Discovery has been destroying value every single year since 2008. That would be very concerning if that was to be true. So those are the on-the-surface numbers, and they paint quite a dire picture. However, these on-the-surface numbers use the net assets. And the net assets contained in the balance sheet include a whole lot of items that are not money that has been invested in the business by either the shareholder or by the debt providers. So I want to make some adjustments to identify exactly what is the invested capital. And I've highlighted here in the box the components that we're going to use. So we're going to use the ordinary share capital and the share premium. Of course, that's money that's raised from shareholders. The retained earnings is the profits that have been kept in the business. There's a minority interest component. We're going to keep that in because in the profit numbers the minority interest component is also in. So we'll keep that in our calculations. Preference shares is money from shareholders, and the long-term interest-bearing debt is of course the long-term debt from financial institutions. And if we add those up, we're going to get something called the invested capital. And note the difference. Here we are in 2008. 5.4 billion is the invested capital, where the net asset number is 8.7 billion. So a material difference between those two. And notice what happens by the time we arrive in 2017, the difference between the invested capital and the net asset or total capital number. That's 25 billion rands worth of difference. And that's made up of accounting numbers on the capital side of the balance sheet that actually don't represent money received from either the equity providers or the debt providers. So it's important that we identify that and take it out. Now once we've got the invested capital component, we don't want to measure the returns against an invested capital number at the end of the year. We want to measure the returns over the year. So we need to get an average invested capital. Simply there, 37 billion is the average of those two. Okay, so that's the important number. Next up, we're going to take the NOPAT, net operating profit after tax. Remember, that's adjusted to take the tax component out. And then we're going to add in the interest income. In a case like Discovery that has a substantial part of or component of interest income, it's important to the operations of their business. Likewise, in businesses like Truworths and Fushini, where they are providing funding or loans to customers that they're funding off their balance sheet, then that's also material to their operations. So that NOPAT plus interest income is important. So now we can measure the return on invested capital. The NOPAT plus the investment income, the interest income, divided by the average cost or average invested capital. And we get here this number of 23.3%. And that number must be higher than the cost of capital in order to suggest that Discovery would be creating value. Now, when we calculated the on the surface numbers before, here we got 16.75. And clearly that's less than the cost of capital, and you might judge that to be destroying value, but in actual fact they are creating value. My conditional formatting here says if this number, the return on invested capital, is higher than the WACC, then paint this green. And if we go along the line, we can see that Discovery has consistently been creating value year in and year out from 2008 all the way to 2015, and then it appears that in 2016 and 17 they start destroying value. So we can measure this also by calculating this EVA. Now I've called it here the adjusted EVA, and it's adjusted to include invested capital and NOPAT plus interest income, so that we're not just using the on the surface numbers that we used further up here. And once we do this calculation, notice how the EVA now turns positive. So here it's 269 million. Our previous calculation got us a negative 610 million. And if we look at every single year of the adjusted EVA calculations, you will find that Discovery is creating value all the way until, there we have it again, 2016 and 2017, when these numbers turn negative and they are destroying value. So the last little piece that I did here that I think is of interest is I calculated, well, what's the capital cost for Discovery? And to get the capital cost, I'm saying, well, we have some invested capital. We've got that number up here, and we've got a capital cost here of very close to 18%. I want to know, well, what is that 18% of the invested capital? And what we have there is essentially a capital cost that we need to overcome. Now the capital cost is made up of a debt component. There's the debt cost, that's the actual interest expense, and there's the equity cost, and of course that's a notional cost. That's not an expense that the business has to pay. However, it's quite useful if we use that, because we can take that equity cost and we can divide it by the number of issued shares, and we can get a total equity cost per share. And in 2008 that turns out to be R1.59 per share. But Discovery actually produced earnings per share of R2.12. And of course what that suggests is the earnings per share goes to shareholders, essentially, is higher than the equity cost per share, which is the expectation that the shareholders had, that they wanted to receive. So again, you can look at my conditional formatting here, which says, is the earnings per share higher than the equity cost per share? Is the actual production of earnings higher than the expectation of earnings? And you can see this is true for every single year, all the way up until 2016, where it turns red and the earnings per share are less than the equity cost in both 16 and 17. So we can see some red flags starting to appear here. The returns are less than the cost of capital, the EVA has turned negative, and the earnings per share is less than the equity cost per share. A couple of red flags starting to appear for Discovery in 2016 and 2017. I just want to recap the importance of the details. The on-the-surface numbers, you see them here at the top, they provide us with very misleading information to suggest that Discovery has been destroying value since 2008 all the way up to date. But the more refined calculation, the looking under the surface, the details tell us that that's not true. In fact, Discovery has been a good value creator. It just turns out that it's in the last 2 years that they have been starting to destroy value. Graphically represented, that looks like this. So the blue bar charts are a cumulative EVA. As the bar chart gets higher and higher, it means that there's value creation in each year, until we see here 2015, really good value creation, and there you see these last 2 years of value destruction. I'm measuring that here on the left hand side. This is cumulative EVA. And by way of comparison, I have plotted the end of year share price for Discovery on the top of this. It's on a log scale here on the right hand side, and you can see the share price as it's trending upwards. Here's 2007, 2008, 2009. Obviously the financial crisis had an impact on the share price in Discovery, even though they were creating value. Obviously that's the market showing some of its emotion here. And here you can see the share price as of the end of 2018 at 147.50 Rand. So good value creation certainly happening there up until the last 2 years. Well, that brings us to an end of our value creation, the details matter, clearly representing that the on the surface numbers when it comes to measuring RONA and EVA can produce results that are very misleading, and one needs to get down into the details in order to get the real numbers.